Hello and welcome to this week's edition of the Educational Vlog. I'm Jason Hatley. I'm the Financial Planning Manager here at Five Plan Partners. Today I want to talk to you about a brand new savings opportunity specifically designed for children known as Trump accounts. You may also hear people refer to these as 530A accounts, just a reference to the Internal Revenue Code section that establishes these accounts. There seems to be a lot of buzz around this topic, and we've gotten a number of questions. So I want to just take some time today to walk you through what the accounts are, how they work, and whether this might be a good option for you and for your family. So let's start with the basics. So what exactly is a Trump account? Think of it as a new type of IRA created to give younger children a financial head start. So what sets the Trump account apart from an actual IRA is that it allows for contributions to be made without the normal earned income requirement. So in other words, until now, kids have generally had to wait until their teen years when they're old enough to have reportable income to be able to open an IRA. The Trump account now allows for savings to begin at birth. So one thing to keep in mind as we talk through this and the various provisions of this new account type is that when the child reaches the age of 18, the account becomes a traditional IRA. Therefore, the additional safeguarding protections that are placed on the Trump accounts will be loosened at that point to reflect normal limitations on traditional IRAs. So since these accounts are designed for young children, there naturally has to be two parties involved in opening the account. First, the child for whom the account's being opened, and then also the adult who's authorized to open the account on behalf of the child. So the qualifications for both roles are really fairly simple. I'll run through them pretty quickly here. So for the child, to be eligible to have an account, they just have to be a U.S. citizen, have a social security number, and be under the age of 18. The adult, on the other hand, also very simple, but a little bit different. To be eligible to open the account, the adult must qualify as an authorized individual for the child. So parents, legal guardians, in some cases even grandparents or adult siblings can open the account as the authorized individual. So not to get too technical on how this works, but there is an order of priority on who can open the account for a child. So for instance, a grandparent can't open the account if a parent is available to do it. So, given this setup, you're probably asking who the account technically belongs to. The account is registered in the child's name with the authorized individual or the adult serving as the custodian of the account until the child reaches the age of 18. So the next question is, how is it funded? How do you get money into it? So the current legislation allows for funding from four different general sources. The first one being individuals. So parents, other family members, friends, really any individual taxpayer that wants to offer some funds to put into your child's account. Second category here being employers. So either the employer of the child who has the account and is under the age of 18, or the employer of the individual who claims the child as a dependent, which would presumably be the authorized individual that opened the account. Either of those employers are able at their choosing to make contributions into the child's account. The third category is nonprofit or charitable organizations. And then the fourth are governmental entities at any level, really, all the way down, from local municipalities all the way up to the federal government themselves. One thing to note here is that contributions from individuals and employers, so the first two categories there, in total are capped at $5,000 per year. So if you expect to receive contributions from multiple sources, You'll probably want to try to coordinate those just to make sure that you don't in total go over that $5,000 annual maximum. One additional point is that the employer contributions um, cannot exceed $2,500 of that $5,000 max per year. And then contributions from nonprofits and governments do not count toward the annual limit and can therefore be made in addition to the $5,000 annual max on the individual and employer contributions. So that's kind of a good segue into what you may have heard as the pilot program for these accounts. It's a feature that seems to be grabbing all the headlines, but what I want you to understand is that this is not it's not the whole story. It's not everything about Trump accounts. It's just kind of a cherry on top for certain children. It's a pilot program where the federal government, through the Treasury Department, makes a one-time $1,000 contribution to the children who are eligible for this pilot program. And to qualify for that, the child has to be born between and including the dates of January 1st, 2025 and December 31st, 2028. We don't know if the pilot program will be extended beyond that end of 2028 window. It's quite possible that it could. However, we probably pretty certain that it won't be retroactively extended past that beginning of 2025 window opening. That being said, it doesn't mean that if you have children under the age of 18 that were born before that date, they are still eligible for the program as a whole. They just are not eligible for that pilot program $1,000 additional contribution. So I don't want to get too deep in the weeds here, but I do think it's worth mentioning, at least at a high level, kind of how these accounts are treated from a tax standpoint. So, with 4 different potential funding sources that we covered earlier, as well as the subsequent growth on the money that's put in the account, each component of the account value is going to be treated a little bit differently from a tax standpoint. So to start with, contributions from individuals, that being the parents, grandparents, friends, whoever it may be, those are going to be made with after-tax dollars. So there's no tax deduction for whoever the individual is that puts the money in. However, through the life of the account and upon future distribution, these funds will be treated as non-taxable basis when it comes out of the account. So those funds, to the extent that they are attributed to that non-taxable contribution from individuals, it will not be taxed on the back end either. Employer contributions, so those are not going to be included in the employee's taxable income when they go in, when they're contributed. They're going to be tax deferred throughout the life of the account, and then will be taxed as ordinary income when they're distributed, much like a normal traditional IRA. Same way, contributions from nonprofits and governments, not taxable income on the front end when the contributions are made, but will be taxed as ordinary income when they're distributed in the future. And then finally, the growth on the account. So you're going to, all these sources presumably going to be putting money into it. That money is going to grow with the market. So that growth will accumulate tax deferred again until distribution of those funds, at which point that money will also be taxed at ordinary income rates. So now that we understand how the account's funded and taxed, how can the account funds be invested? These accounts are designed to be simple and low cost, so there are restrictions on the investment options that are available. First of all, the funds must be invested in U.S. stock market index funds that carry expense ratios of 0.1% or less. So no individual stock positions, no cryptocurrencies, no alternative investments. These must either be mutual funds or ETFs, and they can be either as long as they are not too narrowly focused and meet that expense ratio requirement. Remember, this is meant to be a long-term growth-focused investment. Okay, so now that we've funded and invested in the account, next question is how can these funds be used eventually? So the first thing that we need to note is that there are absolutely no withdrawals allowed from Trump accounts before the age of 18. The only exception there being for the purpose of if you accidentally over contribute, exceed that $5,000 maximum in a year, then there is an avenue to correct those excess contributions. So as a reminder, at age 18, the account essentially converts from a Trump account into a traditional IRA, at which point the distributions generally can't be made until age 59 and a half without that 10% early withdrawal penalty. However, as you may be aware, there are a number of situations that allow for exceptions to the penalty, but not the ordinary tax that you would be assessed on the distribution. And the presumption is that these same early withdrawal penalty exceptions would apply to IRAs that have been converted from Trump accounts. So, again, these accounts are intended to be long-term investments for retirement and not intended to be used really any earlier than that normal retirement age, distribution time frame. So before we get into how to open these accounts, I just want to take a minute to kind of remind you of a few considerations to take into account when you're thinking about whether Trump accounts make sense and where these might fit into your overall family financial plan. So one thing, that there are several ways that you can begin saving for your children at whatever age they are. And the type of account that you should consider using depends on how you want those funds to be used by the child and when you want them to be able to access the funds. Trump accounts don't replace any existing account type. They really just provide for a need that was previously unserved, namely to begin retirement savings for young children who were not able to earn a reportable wage and cover that earned income requirement. And so as a result of these, I would say, they really, you shouldn't think about using these in place of a 529 or any other kind of savings vehicle, but rather, use them or open them in concert with those other types of savings plans. So hopefully with the information that we've already covered, you're starting to get an idea of whether Trump accounts are something that you'd be interested in, something that would make sense for your family. So now let's get into, how exactly do you go about opening an account? So first thing I want to mention is that the Trump accounts cannot officially be established and opened until July the 4th of 2026. So as of the date of this recording, we're still about 2 months away from that date. Secondly, until some point after that July 4th date, no financial advisor, regardless of what broker dealer they're affiliated with, is going to be able to open a Trump account for you. To start with, at the beginning of the program and the rollout of the program, all Trump accounts are going to initially have to be opened and established by the U.S. Treasury Department. And they're going to do this using an enrollment process that you can actually begin now. The process is fairly straightforward. It's pretty simple to complete, and you can do it either by manually filing an IRS form 4547 or completing an online questionnaire at trumpaccounts.gov, where you basically just go in and key in the information and it completes and submits that form 4547 for you. Now, at some point after the July 4th program start date, your individual financial advisor will be able to open a Trump account at their institution and transfer the account that was opened at the Treasury into that account. It will remain a Trump account. It will retain all the features that we've talked about. It's just that initially it has to be opened by the Treasury before it can be transferred to a financial advisor. In completing the enrollment process, whether it's done manually or through that online questionnaire, all you really need is just to provide your name, your social, your date of birth, and contact information as the authorized individual, and then the same information for each child that you want to enroll. So, as with any new government program, there are still some wrinkles that are being ironed out, and we'll continue to get more guidance from the Treasury as the program gets up and running. If you're wondering whether a Trump account makes sense for your family, I'd be happy to talk to you, walk you through it, and help you make a good informed decision. Thanks for watching, and as always, feel free to reach out to us if you have any questions.